Welcome to the Tideline Compass series of conversations with leaders in impact investing, and thank you for joining us. I'm Ben Thornley, a managing partner at Tideline, and I'll be joined in moderating today's session by Jane Bieneman, a senior advisor at Tideline. In a few minutes, I'll have the privilege of introducing a truly outstanding panel. But before I do, I can't think of a better person to introduce the discussion topic than Jane, who is one of the most experienced practitioners in impact investing, fund strategy and fund formation. Recognizing Jane's leadership, Pensions and Investments recently published her commentary on the institutionalization of the impact investment market. Jane, it's over to you.
Thank you, Ben. It's great to be here today with you and our guests to talk about the impact market and specifically how institutional it is, including from where Tideline sits, now 7 years into our journey, working with over 115 clients, managing more than 230 billion of impact capital. And what I mean by how institutional the market is the degree to which it meets the requirements of the largest asset owners. So pension funds, sovereign wealth funds, arms of financial institutions, these types of very large investors. And this is a group that historically has not participated in a big or proportionate way in impact investing. And as a result, although the market's grown, it's remained relatively small. In the private markets, which is the focus of our discussion today, one study sized the impact portion of the market not too long ago at under $500 billion, or a fraction of the size of the conventional market. What we're now seeing and very excited to explore with our group today is a real pickup in investor demand. Temasik's $500 million commitment to Leapfrog is a prime example, as is New York State Commons' $300 million investment in Avenue Capital's Impact Fund. And we're delighted to have John Larkin, Head of Impact Investing at Avenue, here with us today. So we've been seeing a real change, and we've been asking ourselves what's behind this momentum, and what does the future look like. We think certainly that in part this increase in demand reflects just general heightened awareness around social and environmental issues. But we also think it's about developments in the market itself, and specifically the impact market increasingly meeting the needs of institutional investors. So I'd like to put up a slide for a moment. And as this slide reflects, we see 5 kind of key requirements for a market to be ready for institutional capital at scale. One is that it's proven, it has established managers with proven track records. 2, there's depth, or that it's sizable, that it can absorb very large investments and commitments of capital, like those I mentioned a few moments ago. 3, that there's good data around performance, financial performance primarily, but also impact performance is part of this. 4th, that there's what we call connectivity, that it's served by expert advisors and other knowledgeable intermediaries who can help to facilitate transactions and provide financial and strategic advice. And finally, that investors themselves have awareness or the information that they need to really understand the ins and outs of the market itself. So our assessment, taking these 5 factors into account, is that the impact market, using a rating scale that we devised, is what we term quote unquote almost ready for widespread institutional adoption. So we are optimistic that we're approaching a tipping point in interest for impact investing, and are very much looking forward to discussing this with our panelists today. So I'm going to turn it back to Ben, who will introduce our fantastic group.
Thanks so much, Jane, and thanks again to those who are joining us for today's Compass series. Please note we will not be using the raise hand or the chat function, but please do provide questions and input them into the Q&A tool, and we'll certainly reserve time for responses from the panelists later in our session. So we're fortunate to be joined today by an extremely experienced group of asset allocators, asset managers, and service providers. Brad Atkins is co-founder and CEO of Franklin Park, a leading private markets advisory firm. Brad works closely with Franklin Park's institutional clients on portfolio planning, construction, and management matters. Thanks for joining us, Brad. Andrew Karsh is a portfolio manager at CalPERS, where he has direct investment responsibilities and serves as a member of the Absolute Return Strategies Advisory Board. He also represents CalPERS on the UN's Global Investors for Sustainable Development Alliance. Thanks, Andrew. John Larkin is head of impact investments at Avenue Capital Group. He leads the $400 million Sustainable Solutions Fund and all other aspects of Avenue's impact strategy. Welcome, John. Suze McCormick is a partner at Morrison & Forrester and perhaps the most seasoned legal practitioner in impact investing. Her practice ranges from late-stage transactions for investors such as SoftBank and Temasek through to high-impact work with foundations, family offices, and specialist private equity funds. Suze, in 2015, was named one of the most innovative lawyers in North America by the Financial Times, which is pretty cool. Dipender Saluja is a partner at Capricorn Investment Group and managing director of Capricorn's immensely successful technology impact fund. He's one of the true pioneers in impact investing going back to before the term was coined. Welcome, Dipender. Great. So our first round of questioning will be level setting. And John, I'm going to begin with you. At a high level, what is an impact investment for Avenue? And what are the key criteria you use to evaluate an impact investment opportunity?
Sure. Thanks again, Ben, for the invite. I'm going to keep this real simple because probably most of the folks on this call are probably practitioners or getting into this space. But for Avenue, we kind of like to see it like most folks. ESG was always going to be like, don't do bad things with bad people in bad places, right? Pure risk assessment. But to go that extra step into the impact space, it was about measurable, right? Having some fidelity to the situation. So we went down the environmental road of the ESG. We're heavy on the environmental side, but it's not at the absence of the S and the G side. The entire firm has now adopted the whole ESG mantra for everything it does. But for this impact fund, for us, it was to focus on the E side, the environmental side, and to put up a system of kind of gates and steps that would basically give us fidelity from the outside investor looking in that we were doing it right.
Great. Thanks, John. But Brad, a question for you. At Franklin Park, how do you distinguish impact investments, further to John's comment, from other investments that factor in ESG? And how do you discern what it is that Franklin Park's institutional clients actually want?
Yeah, well, first of all, thank you for having me on the panel, Ben. So we're a private market fund investor. And I would say that today, the majority of our managers have incorporated ESG policies into their investment process or into their firm management. That was not the case a few years ago, but certainly today it's become, I think, common practice for managers to incorporate ESG into their business. The impact market, of course, is much narrower than that, much smaller than that. A growing segment, certainly, but we track over 6,000 private market managers broadly, and about 300 or so are what we qualify as impact managers. And we qualify groups as impact based on three attributes. One, is their fund or their strategy focused on providing measurable and positive environmental or social impact? Secondly, does the manager define their fund, their investment as an impact investment? And thirdly, do they report to their investors the positive impact they're having on the environment or society? And so that's how we qualify funds managers as impact or not. In terms of our clients, of course, this is still a relatively new area of investment for institutional investors. It's certainly growing, but I would say still relatively early stages for our client base. But we help our clients build a comprehensive solution for their impact aspirations. We help them, first of all, clarify, define what impact means for them. Where do they want to focus? And so every client may have a different area of focus, whether it be empowerment or the environment or education, or is it broad-based? And so we help them clarify what their goals, objectives are. We help them write their investment policy for impact investing. We help them establish guidelines. We help them establish their investment criteria. We help them develop an investment plan for their program. We help them develop measurement tools, benchmark tools. So in summary, I'd say a comprehensive solution, Ben, to addressing each client's needs, but each client is different. And so they all have unique needs. And so we offer a bespoke solution to help our clients into this relatively new field for them.
Right. Thanks, Brad. Andrew, CalPERS actions are in their own right a significant signal of institutional readiness. Do you see impact investing as a viable option for the system?
Sure. Thanks, Ben, and good to see you. So I think one of the things that most people are aware of with CalPERS is our different views regarding ESG, and as opposed to a lot of organizations that have historically focused on divestment, we've been very focused on activism, including our actions last week around the Exxon board meeting and my colleague who is the head of Climate Action 100 Plus. And so clearly, we've been using our $450 billion asset base to try and influence companies that are existing in significant ways. And so, I think that the institutional readiness, particularly, on our side, is always a challenge because just the sheer scale of our asset base and the fiduciary responsibilities that we have in terms of meeting certain return metrics. So the way I like to think about impact investing now, and thanks to my colleagues, they hit some terrific points on where impact investing is in terms of the scale and the scope versus other asset classes. I kind of feel like we're in a position now where impact investing is coming to us rather than us moving to impact investing, because as it continues to grow and prove itself as an ability to meet the same market returns that we're required to produce for our 2 million members, then we'll continue to have more opportunities to invest in that space. And that, in that context, we are continuing to evaluate managers based on not only their performance, but also, impact.
Right. Thanks, Andrew. Dependa, Capricorn was founded 16 years ago specifically to make impact investments. What is the success of the strategy that you've led at Capricorn say to you about what's changed since the time when Capricorn was founded?
Thanks, Ben. Thanks for having us. So since we were founded, so if you think about a decade and a half ago, you mentioned at the top of the talk that this was even before the term impact investing was coined. So obviously, people have been investing in various ways with impact for a long time. It was more, thinking about it and saying, can you bring some intentionality to this process and do this with that intent of saying, we're making investments, the investments are going to be successful as investments, and they're going to have a positive impact. And that was our goal. And we saw many tools to do that. We chose the tool of the investment dollar. And within that, you're highlighting the work that we do in venture capital. And there, we decided to choose marrying technology with big problem areas in the world. We saw lots of opportunity in the kinds of things that were happening in Silicon Valley 30 years ago, 20 years ago, 15 years ago, and marrying those with the large areas of energy, transportation, agriculture, other areas, food, space, and create meaningful companies that were specifically going to build products and go right at the heart of some of the big challenges that were facing the world and turn them into large opportunities. Sounds cliche, but that was our intent. And the first area we chose was climate, because we thought, one, that was a very urgent area, and secondly, we saw the evolution of technologies like electrification at a state where we could help build large iconic companies that would change the way things had been done for decades prior to that. And that's clearly been one of the areas that the world has rallied around. And so what has changed is, at that time, it was a lonely place. A lot of people were very skeptical because this idea of mixing profit and purpose was not recognized as a viable tool. It was like you wake up in the morning thinking about one or the other, but not both. And I think a decade and a half later, there are many examples of companies that have been successful in that space, and we've been proud to back several of them. And so what I think the main thing that has changed is it's gone from niche and viewed with cynicism to this can be done, and this can be done well. And I think at this point, a recognition that this can be done at scale, which is really what's important. Can we do this at scale, and can we take it out of a very niche ESG focus only, where people think of it as a 2 or 3% of what they do, to mainstreaming it.
Right. Well, thank you, Dipender. And Suze, you've recently published a report on the explosive growth in institutional investor demand for impact, with the Impact Capital Managers Network of 66 impact GPs. What, in your view, have been the key trends that have been driving that explosive growth in demand?
Well, I think, again, thanks for having me. Great to be on this panel. I want to echo what my fellow panelists have talked about, and sort of distinguishing between sort of ESG on one side and impact on the other. Very, very related, obviously, talking about the same issues. But I think John said it very well. ESG is, it relates to every company. You can focus on the ESG as folks have with Exxon, with Chevron, with companies in the traditional and the dirty economy, in addition to sort of impact companies. And that is sort of my first point when the fund managers and the LPs that we interviewed, and we did the report, really did. Some of us have been practicing this space for 20 years and sort of get sick of people going, oh, you're doing all this innovation. It's kind of what Dipender said. It's like, well, we started it 20 years ago and we're now doing it with $2 billion funds. So I'm not sure it's innovative. Yeah, maybe you haven't done it before, but I'm not sure it's innovative. But there's a whole segment of ESG, which I think really the institutional investors have recognized drives value. I mean, purely, whether it's equality, whether it's cybersecurity and privacy, whether it's climate, whether it's their supply chain, sort of separate from impact. This is key, either from a risk compliance or an opportunity. I think there is a recognition, Andrews, I know some folks in the institutional, most folks in the large institutional world believe, if you're not doing climate risk scenario analysis in connection with your portfolio, you're just being stupid from a financial perspective, regardless of anything else. There are then a lot of folks who sort of side on the impact, and really they see an opportunity. They are like Dipender, they are like Obvious Ventures. It sounds like they are like the funds in which Brad invests, where they believe that the product or the service or the technology that is being developed really, when you develop solutions for these problems, that those will be the most, the companies that succeed the most over the next couple decades. And I think they're funds like Dipenders that have really proved out that model over time. But interestingly, there's really a third sector, and some of this is driven by their constituents, whether it's students at a university or whether it is, firefighters and the pension fund, or it's the asset managers themselves who believe that some of these really global challenges are going to impact every company long term, and they really have an obligation to start focusing on them in the short term. And I commend to all of you the Institutional Investor Roundtable, and they actually described kind of the global economic challenges. Climate is one, global healthcare, sustainable mobility, sustainable energy, global food and water sufficiency, and building that in. And the IIR, I think, has $35 trillion of institutional capital that are starting to say to the asset managers, hey, you need to be either focused on this in part of your portfolio or integrating it as part of ESG.
Great, thanks, Suze. I'm going to turn it over to Jane to lead a second round of questioning.
Okay, thank you, Ben. Great. Yeah, I'd like to ask the group some questions, getting a bit specifically into kind of degree of investor appetite, what you all are seeing in terms of institutional investor appetite, and what kind of challenges and opportunities are around that. And Brad, I'd like to start with you, very much building on your first comments. And I know you've been looking at impact investing, as you described, for a while. How are you seeing demand among your clients change, and why? And related to that, how strong is the pipeline to meet that demand? And I know you mentioned 300 of the products that or managers that you've screened are labeled impact. How robust is the supply relative to your client demand currently?
Yeah, on the first part of the question, so we as an advisor in private markets work with institutional investors, and our clients comprise state, county, city, pension funds, endowments, foundations, health systems, religious plans, et cetera. And I would say the vast majority are discussing impact investing today. Again, that was not the case a couple of years ago. So they're all discussing it today. The impact investment initiative often gets started at the board level, and the board then asks the investment staff, who then asks the advisor to figure this out for them. A couple of observations. One is that, as you've heard others say, I guess, is that oftentimes ESG, divestment, diversity and inclusion, impact investing all get lumped together, and they're all distinct, obviously. Secondly, the discussion sometimes leads to, there's still some cynicism, let's be honest, right? And so there's still a question that we get about, does impact investing mean sacrificing return? Does impact investing mean that we're not upholding our fiduciary duty as a trustee of these boards? And so there's still those questions, there's still that struggle, there's still that discussion happening at the board level, at the client level. Oftentimes what happens is there may be an impact lens put onto the existing portfolio to say, we're not allocating more capital, but rather we're looking at our current investment portfolio and saying which investments may qualify as impact. And then yes, in some cases it does lead to certainly capital being allocated into the impact investment space. As mentioned earlier, the manager universe from our perspective is certainly growing rapidly. As mentioned, we see and track 300 plus impact managers. Again, that has doubled, I think, in the last couple of years. So certainly a growing area of investment for us.
Great, thank you, Brad. So that's a good segue to a couple of questions for you, Andrew. As a representative of one of the largest asset owners in the world, How confident are you that CalPERS would have the information and support you need today to make investments with the same, rigor and discipline as you apply to other investments? And what kind of additional data, capacity, advisory services would you like to see in this space?
Yeah, thanks, Shane. That's a good question. I mean, I think one of the reflections on this space, having spent the last year and a half as part of this UN GISD working group alongside 30 of the largest financial institutions in the world, issue in terms of where we're sitting. In effect, we spent the first 6 months deciding on a taxonomy of what all these definitions were of how we're effectively trying to create capital flows into investment opportunities that support the Sustainable Development Goals. And so the fact that we spent the first 6 months of a 2-year program deciding what the terminology is was clear to me that there needs to be more standardization and certainly more transparency in terms of the way that people are evaluating these investment opportunities. And so I think the good part, and certainly this has been reflected by other panelists, is that people are having this conversation, whereas 5 years ago, they wouldn't be having that at all, right? And so the fact that you can get 30 of the largest financial institutions in the world trying to figure out how to solve some of these issues and actually making a concerted effort about determining where there's investment opportunities and where there's capital flow, and even things that the direct investments that I'm dealing with, we're trying to figure out, okay, how do we fit these into our portfolio and our requirements, is clearly leaps and bounds about where it was not even 3 years ago. And obviously, the unfortunate dynamics of the pandemic and some of the situations in the US have magnified and accelerated a lot of those conversations within organizations. So, I'm feeling very good about the space in terms of the focus and the renewed interest and the mandate in terms of people's interest in moving into it. I mean, clearly, CalPERS is a different animal in terms of the size and what we're able to do based on just sort of the sheer scale of what the capital base we have to invest. But, that being said, there are, again, major organizations, whether it's banks, asset managers, asset owners, who are having the conversation of, how do we do things that are more impactful, even if it's not labeled impact investing per se, but at least, there's sort of this continuum from, ESG to impact that people are moving along as the investment opportunities become scalable enough for them to meet the mandates that they have from their respective, boards and asset allocation models. But in terms of the advisory services, again, I think having, more standardization, and I look back at the bond rating models, 20 years ago, there were probably a dozen rating agencies that had different bond ratings and things like that. And now we've got 3 major ones. And so, as we've seen more consolidation in the industry, again, with organizations like SASB and whatnot, who are consolidating because they're realizing, how do you get people to focus on the goal if they've got 6 different metrics that they can use to determine, what they're actually achieving? And so I suspect, to your point, that there will be more focus on the key players in this space and the thought leaders who, are able to get, focus from the organizations that are allocating capital and those that are managing capital will be the ones that will become the, the forebearers for the, for the market going forward. And, we're all working towards that same end goal.
Great, thank you, Andrew. That all really resonates with me, including the value of coalescing around standards in the industry. So thank you. Dipender, love to turn to you for a couple of questions. How did Capricorn approach breaking down the institutional barriers that exist to making impact investments in the market? And do you feel that those are breaking down? And then lastly, what do you see overall as the state of asset owner or LP readiness to back impact strategies?
Sure. So, you heard a couple of comments earlier. Brad mentioned it as well. Since we chose the investment tool to have this impact, and within that venture capital, the biggest barrier initially was the piece that you just heard a couple of times, right? The cynicism around, will you have to compromise the financial return versus that? And so that was sort of our first area of focus, to go down and make sure we could do both, which is what investors expect at the end of the day. right, is will they end up losing their investment or not making a return that they need in that asset class. So we started with a small group of LPs to begin with, those who had the conviction that this was indeed possible. And our first task at hand was to be successful at it and to be able to demonstrate that is possible. And clearly, that was not an artificial exercise for us, because our goal was to be successful with it. And we didn't have any schizophrenia around that if we could build and help back companies that would be successful, that means their product would be more widely adopted, and therefore it would have more impact. And if that product was widely adapted, the companies would gain in value, and the investors would get a better return. So it wasn't rocket science. We were investing in rocket science, but this concept was not rocket science. And so that was the first task at hand. And over the decade and a half, we've been then able to move from the initial small group to a broader set of LPs. We spent quite a bit of time working with foundation endowments, pension funds, university endowments, hedge funds, basically, all pools of capital that you would see in traditional venture capital. And it was one step at a time, and we're really thrilled to see many institutions around the world now come into the space. The global aspect was also interesting. It started off primarily, as a US-based activity for the group that we were involved with. There was interest in Europe, and now I would say, we have institutions from pretty much every continent and many countries around the world that are participating with us or participating or acting on their own. And the second thing was making sure that what was again said earlier is that institution viewed this not as a very small percentage of their activity, because you're only going to have impact, and this is going to be meaningful if it's at scale. And it's somewhat self-fulfilling, because a lot of investors, like a lot of other businesses in the world, also look at what others are doing. And not everybody has the luxury to be a pioneer in terms of thinking about, I'm going to stick my neck out and go try something new. And so, success ends up giving other people confidence, and people see their peers having good experiences with it, and people see their peers smiling, and people see their peers and saying, this is not something niche, and then others weigh in. And that's really important, right? Because not everybody has the luxury of making some of those early pioneering decisions. And so mainstreaming it, to take it from the 5% to the 95% of the capital base was another very, very important thing. And I'm really glad to see that happening now.
Great, thank you, Dipender. Those are all really helpful comments, and I'm glad you and the rest of the panelists are hitting in particular the misperception about returns, because that's a question I get a lot from mainstream GPs, is if I think I have an impact element, but if I express that, will that communicate something about concessionary returns? So I think that's a myth we continue to need to put to bed, certainly. Suze, love to turn to you now. What are the market infrastructure developments, particularly around legal innovations, you're seeing that have made impact investing a more attractive, let's say more institutional opportunity?
Well, I'd actually like to tie this to the point that you all have been making, that one of the issues that I think this field faces is that impact means all things to all people. So if you look at, having been in it for 25 years now, impact investing is a tool used by foundations that are impact first, that are investing as opposed to making grants, right? And impact investing is being used by hedge funds to purely to drive short-term returns. So when you have one term that means everything, when you're trying to prove the case that it's not concessionary, they can always point to things that are impact first, because it is such a broad term. And maybe we've all talked about sort of the need for terminology and the need for standards. I would say that relates to corporate forms as well. We are trying to open source a lot more, but really the right structures related to aggregating capital, deploying capital, the other underlying corporate form. There is no one size fits all. I mean, B Corp is just a certification. You pay to license the mark, but I often get like, I want to be a permanent asset vehicle. I want to be a B Corp. And I'm always like, well, what do you want to accomplish? What impact are you driving for? Because there isn't a one size fits all. There isn't, and the other thing I'm often combating, just like that impact has to be concessionary, is that these are gimmicks, or that if they set it up in their fund, LPs won't come because it's new and it's different. We've got to use the bog standard GP LP structure. That was true a number of years ago when we started playing 10 or so years ago. Now we've got billions of dollars of assets under management that have tried, and these tools are on a continuum. So aggregation of capital, there are interesting things that have happened. I think the most innovative and the most the most potential for real impact and returns is having a public charity in your GP. That's the RRG TNC model. They're permanent asset vehicles. I saw my friend Diana Proper's on Crane Mirror Generate, raising billions of dollars with a slightly different Brookfield, different structure. And then the California Rebuilding Fund, we're raising $1 billion with the PBLLC under a public charity, which eliminates all of the RIA and compliance costs. So aggregating capital, deploying capital, they're tools we use with convertible debt, preferred equity, and obviously in the public markets, they're the 5 flavors of green bonds. It is good. It's not enough to say, yeah, the use of proceeds, there is really a rigor. And I get most excited about the performance-based, i.e. You can link the bonds, rating the bonds to, and the bonds interest rate to certain ESG performance. And I really like when we are combining, Brad said these all mean different things, but when we combine inequality with climate, when we've come up with financial instruments where you provide the funding for low-income housing, and you also do the hard stuff, which is that low-income housing is on property that is going to be underwater in 20 years. So can we marry it with a tranche of concessionary capital or with a performance-linked bond to actually have a twofer to deal with both at the same time? And then finally, I'll talk about it at the last question, the corporate form. We've gone from 0 to 60. Again, a B Corp certification, benefit corporation, most states doesn't really work. The PBC, the Public Benefit Corporation in Delaware, we now have 8 publicly traded PBCs. So shifting the fiduciary duty to a shareholder ESG, agreed ESG goal is key. And I would just say, for those who think it's gimmicky, the most successful IPO last year on financial terms alone was a PBC in Lemonade. So, and I worked with SoftBank investing into that entity. So they're still novel, but I would just commend, especially to the asset managers looking at them. I will tell you, the institutional investors are certainly looking at them and will ask you questions about it if you don't know. And again, impact capital managers, we interviewed 53 to kind of, and 40% of them were using some of these tools.
Great, thank you, Sue. That was all really interesting, and I loved your comment that you ask clients what it is they want to achieve, because it really does all start with strategy, but then there's so many levers to pull around structure. So that was terrific. Ben, I'm going to turn it back to you, and I think we've got some questions from the audience.
We do. Thanks, Jane. I'm going to begin with a question to Brad and Andrew. Brad, I'll start with you. We've had a few questions about some of the key barriers that have come up with respect to what institutions are able to do. I think one is scale. Andrew, I'll come to you and ask you the same question in a second here. So the scale of what it's possible to do at impact and the extent to which that's a barrier for your institutional clients and how you overcome that barrier. I think a sense of return and what you would expect to see from a return perspective, and what you are seeing among the 300 managers you've mentioned vis-a-vis their returns compared against non-impact funds. And then finally, whether regulation is having either a chilling effect among your clients, or perhaps even opening folks' minds to making these kind of investments. And there's a specific question about Taft-Hartley labor-related pension funds and whether this is something they've taken an interest in. So a bunch of questions, Brad, about pushing through some of those hurdles and barriers, and would welcome your response.
Yeah, all great questions. So let's see. So I guess to start, I'd say, as mentioned, so we're a private market specialist investing across private equity, private debt, venture capital, real assets, US, non-US. And we see on average 900 fund investments per year, excuse me. And we invest in 30 or 35 or so investments per year on the fund side. And so very high bar to select individual funds to back. A very thorough, of course, evaluation and screening process. And we're looking for best ideas. And so of the 900 funds, what are the best 30 or 35 funds to invest in per year? And we don't have a different bar. We don't have a different process, don't have a different criteria for impact versus traditional. It's the same funnel of funds that we look at, and we try to find the best 35 or so funds. And some of those funds will end up qualifying, based on the earlier discussion, will qualify as impact investments. And so we average probably 4 or 5 of those 35 or so funds per year are impact funds. And so that kind of addresses the scale point. It's a yes, we think there are investments out there that still meet our very thorough process and still meet our bar that also qualify as impact investments without sacrificing return. And so very selective process. To the Taft-Hartley labor plan question, yes, across the board, every type of client we've had has had, again, as mentioned earlier, at least interest in this impact category. They all have different objectives, of course, and different areas of focus, but Taft-Hartley's to health systems to public plans from our client base are all asking about building impact programs.
Great, thanks, Brad. And Andrew, same question to you, particularly around the scale. Obviously, with almost $500 billion, it's tough for CalPERS to write smaller checks. But as you become more eager to do that on topics that CalPERS cares about, what are the creative ways you deal with that challenge?
Sure, thanks. And you know what, I totally agree with what Brad was just saying, which is the model for most large institutions, unless they have more flexible mandate. Obviously, if you're talking about, endowments or foundations, they have some more flexibility in terms of what they're allowed to invest in, what their mandate is, things like that. So I would actually reiterate a lot of what Brad said, which is, again, my day job is focusing on direct investments rather than managers. But, I think it's more so this scope of, if you're going to be hiring managers in an asset class and you've got a certain amount of capital, and some of those managers that already qualify happen to be impactful, then I think that's terrific. I think that we haven't seen, at least I can only speak for our own organization, we haven't seen a mandate to say, okay, you need to invest in impact at all costs. Because I think that, it's public knowledge, we previously had an ESG bucket that was specifically allocated to those managers, and based on their performance, the board and the chief investment officer, I believe it was 7 or 8 years ago, defunded that to put it back into the overall asset allocation model to have this ESG integration philosophy. And that's what we've been working based on. And so, similar to my comments before, I feel like impact is coming to us rather than us going to impact. And again, a lot of that is situationally specific based on, to your point, the asset base that we have, the mandate from the board, as well as sort of the fiduciary responsibility. But I think that being said, again, there are managers that are moving into this sphere that fit, the types of things that we can invest in. And so I think that's been extremely encouraging.
Right. Thanks, Andrew. John Depender, we've had some questions about investment returns and how, again, they compare between impact and non-impact funds. I was hoping that you may both be able to share some sense of how you've been performing, and there's also a question about first-time funds in both your cases, John Depender, in terms of technology impact fund, as well as John, the Sustainable Solutions Fund. Those were essentially first-time funds. So your experience of trying to give your institutional investors confidence that you had the track record, or you could create a synthetic track record from other work you've done to make those new products possible would be helpful to hear about as well. So overcoming the performance barrier, overcoming the first time fund barrier. John, perhaps we can begin with you.
Sure. I won't lie, it wasn't easy. So if you go back, the advantage of having an Avenue Capital, a 26-year-old credit firm, and then having the support from your front office saying, we're going to do this, right? We're going to actually put this together. But nothing happens fast when you create a new strategy within an organization like the size of Avenue Capital. So that dialogue started over 3.5 years ago. And it was, if we build it, they will come. And there wasn't a whole lot of interest for a first time impact direct lending credit fund in the United States, even 3.5 years ago. Most of the consultants, all the consultants out there said, well, that's a really good idea, but we have never seen that out of the United States. You go to Europe, you're going to see just a plethora of these things out there. But in the United States, we were really kind of an odd bird out there. And then I remember it like it was yesterday, the summer of 2019, the world changed and everybody knew about impact. And so we launched our fund actually just around that time. We brought all the folks together. We brought on Tideline. I'm sorry, I got to disclose it. Tideline was our advisor on this thing to make sure that we had that validity and that those bells, belt and suspenders controls over what we're going to do. But we really thought it was all going to be high net worth money. I mean, if you had asked me back then, I would have thought, and that's what the first people were coming at us, were high net worth folks, family office money. That's not what happened, right? It ended up turning out to be an institutional money. And even today, it's mainly pension fund money. That is the interest level since then. We've closed the fund, and even since the last close, most folks coming at us are large institutions asking when's the next one, that kind of thing. Performance, you don't sacrifice performance. Not to get my compliance guys crazy with me, but we're probably the first or second best performing fund right now in Avenue. So you don't sacrifice that. And some of that is also, it's not the impact part. Although I would throw this to the rest of the folks on the screen here. Today, there's actually an impact premium to what we're doing. The companies that we talk to, remember, we're direct lenders. We're actually giving money to these new companies. It's post-venture. It's kind of fitting in that new world. And those folks actually like it. They actually like doing these due diligence questionnaires. Who would have thought, right? And adding covenants to documents for impact covenants, which are, onerous things. They love it. They actually love it. Hopefully that keeps going. First time fund, I would say those of you out there, I looked ahead at the questions there. If you're starting out, it's a different world than it was 3 years ago. Today, people know what you're talking about. Institutions do understand what this is. Just make sure that you can support everything you say you're going to do on the reporting side. Just make sure you've got that all kind of figured out, so you don't, somebody doesn't poke holes in your thesis. But performance-wise, it's no different than any other fund, right? We all have to compete side by side for the best performance.
Right. Well, thanks, John. Depender, same question to you. How's performance been, and how was it out there as a first-time manager? Although that was a while ago now.
Yeah. So actually, technically, our Technology Impact Fund, was named that for the first time, but it came on the heels of us doing that for a decade before that. And so think of it more as going from a smaller group of LPs to a larger, broader, in the same way that you would go do any venture fund and, go talk to institutions around the world. So in that sense, it was the first time, but luckily we didn't, it wasn't just the first time that we were doing it. We did not find any institutions that we talked to that had a mandate to be able to do this with a concessionary mindset. It was, first of all, it was very hard to find institutions who had a mandate period to do this. There were many who had started thinking about it, and many who were on the way to formulating some ideas and allocation to it, but there weren't that many at that time that had this mandate. So from a practical point of view, it had to come out of whatever their allocation was for venture capital. And so it was essentially them believing that the returns would be in the range of what they would expect any other venture capital fund to be, and that they weren't going to be too hurt. They obviously, like I said initially, there was cynicism, so some expected it towards the bottom end of the range, some expected it to be towards the middle of the range. I think if you look across and maybe many of the others who are LPs around the table or look at the data, Suze, Mac, Suze, Brad, Andrew, others will tell you the same thing. I think if you look at the last 3 or 4 or 5 years, since more and more funds started coming in, you'll be surprised that much of this work is now top quartile, top decile, top 5%, which is great, right? Which is what you would want to see. Now the fund begins, and can you scale it beyond where it is, and can you mainstream it?
Right, well, thanks, Dipender. I think we have time just for a final lightning round of questions here from Jane. So we'll be keeping our answers to 1 minute or less. Thank you for all the questions from the audience. We appreciated them. And Jane, I'll turn it back to you.
Okay, thanks, Ben. Great. We'll do a final round robin, final words of wisdom from each of you. So I'll start with a question for our two GPs, for John and Dipender, and to Suze. And that is, what trend in impact investing are you seeing that has the most potential to really drive institutional demand in the future? And John, I'll turn to you first.
Demand, I separate the two worlds, right? Obviously, the social impact folks and the environmental and the climate impact folks. On the environmental side, it's broadening out. It's definitely not just, it's hard to make a really high returns right now in just wind and solar. So I think you're seeing the broadening out of that category of environmental low carbon strategies, smart cities, transportation area, food, water, waste, all those things are just becoming easier to sit there and exploit. And new technologies evolved.
Great. Dipender?
I would say, a recognition that building businesses and therefore making investments in things that are massive problems, but are also therefore some of the biggest opportunities in the world, can do wonders for your investment and can really return that. And there's nothing like finding those types of areas where you can have the convergence of those both, because most people I know can then sleep well at night knowing that the chances of it working out are a lot better than creating the 18th company to sell pet food on the internet.
Great. Broadening out opportunities and solving big problems sound like big target markets for our two GPs. Suze, I'll turn to you now with the same question about trend driving future institutional demand.
I'll go back to the corporate form and particularly the use of the public benefit corporation or the social purpose corporation. So two things. Number one, the old model of making money and giving it away on the side is fatally flawed. Foundations are fatally flawed. We have to move out of that mindset, number one. And there are a lot of things you can do with tax exempt and public charities. But number two, a misconception I get from many people is that a PBC has to be concessionary capital. That is, if you have a dual fiduciary duty, that is not the case. The difference between a public benefit corporation and a benefit corporation in most states is you can have a mission, a public benefit where there's 100% overlap between making money and your profit. Laureate, your mission is education, your mission is carbon emission reduction, and that's also what drives the revenue for the company. And so that, I think, then the fact that now we have 8 publicly traded, I'm advising on 5 SPACs that are PBC. I think this shift, and then the ability to shift the dirty economy using these forms is going to be incredibly impactful.
Thank you. That's so interesting. Okay, final question for Andrew and Brad. What is your advice to GPs considering launching an impact strategy? What should they consider and how should they approach the market? Big question, but I know of a lot of interest. So Andrew, if I could, I'll start with you with that question.
Sure, thanks. I think, especially considering this forum is about institutional investors in impact, I think, the key component is, and I get lots of questions on this from, early managers, is understanding the way institutions think about allocating capital is from the top down. You've got a board, you've got a mandate, you've got asset classes, and you've got a responsibility that's based on each organization. And so understanding that, as opposed to, lots of terrific, early stage, smaller impact managers that are very enthusiastic, and they call me up and say, oh, how do I raise money from CalPERS? I said, well, it's not really that simple. And, explain this top down asset allocation model. And I think it's a little bit surprising to them. So I think, for, especially with regards to dealing with institutions, kind of understanding what the metrics are. And I think both myself and Brad covered a lot of that today in terms of what the requirements are to be able to receive capital from large institutions is important, and understanding that that's different than what the traditional, impact oriented investors from, family offices and smaller foundations and people like that are. So, I think it'll just sort of help have a reality check, just specifically on some of these early stage. If you look at there's lots of early venture impact funds that are, again, very enthusiastic, but there's a big gap between, what you can raise money for from, the family office community versus, large institutional investors. So, hopefully that's a helpful guideline to those who are thinking about it.
Thank you, Andrew. That's very valuable advice. Brad, returning to you for the final word today.
I guess I would just share with the managers the attributes that we look for in selecting managers. As mentioned earlier, it's the same bar that we set for traditional managers, we set for impact. There's really no differentiation, same process, same funnel. And we look for 3 things across all funds, right? Compelling strategy, where you can generate above market returns. Groups that have some sustainable advantage in their market relative to their peers, whether it be in their deal sourcing, origination effort, resources, whether it be on their domain expertise to underwrite deals better, whether it be their ability to add value more so than their peers. And thirdly, an experienced and a driven team, right? Combination of having proof points, track record, expertise in a certain area, but also still being passionate, driven, and aligned with your limited partners.
Thank you, Brad. Those are really helpful insights as well. So we are up on the hour, but on behalf of Ben and me and the Tideline team, just a very sincere thanks to our panelists for their time and participation and great insights. And thank you to all of our participants for joining this Compass session.
Thank you, Jane and Ben.
Great. Thank you.
Thank you.
Thank you all.